All right, everyone. I want to say welcome to everyone for joining us on today's webinar where we're going to discuss, is passive income really passive? Is passive investing really passive? So really excited to dive into this topic today because this is a question that I get a lot from a lot of first-time investors, a lot of people who are passively investing for the first time, a lot of people who are interested in passively investing and just kind of doing the educational side of things, doing their due diligence before they get started. They're curious how much work is really involved when it comes to passive investing. So we're going to talk a little bit about the myth and, is passive income truly passive, today on today's webinar. So just a little bit of housekeeping stuff. If you have any questions or any comments or any feedback, please put them in the Q&A. I'll be going through those at the end of the webinar. So I want to make sure I get as many questions answered as I can. So as we have people coming in, we're going to go ahead and get started. All right. Right. So everyone should be able to see my screen. All right. Looks like we're in good shape. So real quick, just housekeeping. If you want these slides, go ahead and text us at the number on your screen. This will get us you into the system, and I'll make sure we get those slides over to you within the next 24 hours. If you see what you like here on the screen, go ahead and text this number and we'll get those slides over to you. Just a quick disclaimer, this webinar is for educational purposes only and should not be considered as legal or accounting or investment advice. So this is something we tell anybody we speak to on phone calls or on webinars or at in-person events. We're here just to provide education and to provide value to you. We encourage everyone to go out, of course, do their due diligence and make sure that they're doing their homework before they make any type of investments. We're just here to guide you. A little bit about Headway Capital. If you don't know who we are and what we do, I want to say welcome. Thanks for joining for the first time. Headway was created to help build and protect the wealth of busy professionals. So our mission is to help offer investment opportunities that provide cash flow, equity appreciation, and tax benefits to help investors achieve their financial independence. And we have a lot of experience managing, sourcing, vetting different types of alternative investments with an exclusive focus on multifamily real estate. So I want to say welcome, Sid and Anam. They are our founders of Headway. Sid was in the oil and gas industry before he got started. I started investing in real estate in 2011, and I guess you can say the rest is history. Started in the single family space, transitioned into the syndication multifamily space as a passive investor in 2014, 2015. And then eventually did his first syndication and start the launch of Headway Capital back in 2017, and with his lovely wife joining him along the way. My name is Brian. As I've mentioned, I'm the Director of Investor Relations here. So I support Sid when he's out there looking for deals. It's my job to make sure that we can bring the equity to the table to get those deals closed. So I'm the Director of IR. So I spend all of my time talking to our current investors, talking to our prospective investors and partners as well, to make sure that we're providing that white glove treatment to all of our investors, and they know exactly what they're getting into, and they have comfort and confidence in their investing decision if they choose to invest with us here at Headway. And then last but not least, here on the team is Umar Naqvi. He is our CFO and Chief Investment Officer. He's the numbers guy. He's the one who makes sure that all these investments perform along with our property management team, since we are vertically integrated. So solid team here at Headway Capital. Some of our core values, what we stand for, these are things that are really important to us. We value transparency and integrity. We also like to make sure we keep lean operations. You know, we are in the investment business, and it's our job to protect our investors' capital and to help grow it. So we only spend money when absolutely necessary. And we hold ourselves accountable and always put our investors first. And that's led to what we like to call the Headway difference, and has led to the track record you see here on the screen. A little over 440 million of assets under management. We've transacted on around 600 million of assets in total when you include our exits. And you'll see here the amount of units we manage and the target investor overall return we're always aiming for. And we currently have over 500 active passive investing partners, I mean, people that have given us a check and decided they trust us with their money and have decided to partner with us. So you'll see here on your screen some testimonials. If anyone's interested in learning more about us, I'll have some contact info at the end, but please don't hesitate to reach out. So with that being said, let's go ahead and get started. Let's go ahead and talk about today's topic, myth busting. Is passive investing really passive? Is it something that you can do and do absolutely no work with? Is it just that mailbox money that we're all hoping for at the end of the day? So we're going to discuss this topic and maybe bust a few myths along the way about passive investing. So let's dive right in. So the first thing, I want to make sure that we highlight the definition of passive investing and what it really means in real estate, right? So the definition of passive income is, in our opinion, income generated with minimal ongoing effort. Again, let me say that again. Passive investing is income generated with minimal ongoing investment, right? That's really important. The word minimal is crucial because it doesn't mean zero. And we're going to talk about that here today. So this typically comes in the form of rental income. So some people consider passive income they get from their residential portfolios, single family houses, that few hundred extra bucks you get from each house. That could be passive income to some people. I personally consider that active income because you're still being very hands on, even if you have a property manager. But some people consider that passive income. The other type of passive income that we really want to talk about today is a type of passive income that comes from multifamily investing in our types of projects in commercial syndications. And you're going to get dividends from these types of investments. Some operators pay monthly, some pay quarterly, but these are the more traditional types of passive investings that I'm talking about. Examples of passive investing income streams in real estate, these can come from various areas. Some people choose to invest in multifamily real estate. That's our bread and butter. We love apartments because there's a lot of units and a lot of people that pay rent, which provides a little bit of risk mitigation for us, right? We love that. You could also invest in hard money funds, right? So here at Headway, for example, we have the Headway Income Fund, which provides monthly dividends to our investors that we get from charging interest for people on loans, right? So we give out loans, we give out hard money loans, and there's a little bit of arbitrage there, and we're able to pay our investors monthly dividends from the interest that we generate. So that's another form of passive income. We're not doing any work. You're just giving us your capital, and you're getting some mailbox money for that, right? But there's a difference between active and passive income, right? So active income requires ongoing effort. Active income is going to require you to be engaged. It's going to require you to pick up phone calls. Even if you have a property manager, active income can still keep you very busy. Passive income, on the other hand, requires a little bit of upfront effort, meaning you do have to invest some time at the beginning to make sure you're getting into the right types of investments and you're vetting the operator. But there's not going to be a lot of ongoing involvement after that, right? You're just going to have to read your emails, you have to watch webinars, and you have to read the financial reports that you get every monthly. That's the extent of the effort required to be a passive investor. And we're going to dive a little bit deeper in that here today. But I wanted to make sure we get this definition off the table first, so we're all speaking the same language. So let's discuss misconceptions about passive investing. I think this is really important because there's definitely some misconceptions when it comes to passive investing. Let's dive into those. So misconception number one, passive income is completely hands off, right? I think we've maybe heard this before. I know I've heard this before. Is passive income completely hands off, right? Here's the truth, right? You still have to put some sort of effort into making sure that your investments are successful, right? That's the hard truth. Nobody wants to hear that necessarily, but you can't just give your money to somebody, cross your fingers, and hope that it's going to be okay. That's just not how these things typically work. Right. So there's some effort required there. And that's really important for me to highlight. You still need to understand what you're investing into. Right. And you also have to stay informed on the progress of the investment. Right. So this requires some effort and it also requires some education because you can't analyze and you can't invest in something you don't understand. So it's not completely hands off. Right. So for somebody to say that it's 100% hands off, that would be a little bit of a lie, right? So it's really important. So let's dive into number two. Misconception number two about passive income, and this is probably my favorite one that I think is the most funny, is that passive investing is a get rich quick scheme or a get rich quick investment opportunity. That is anything but the truth, right? Passive income takes time. It is something that you have to plan to invest in for at least 3 to 5 years because that's how long we hold our projects. But really, anybody who's getting into passive investing, especially if you're investing in syndications like multifamily investments, industrial investments, mobile home parks, all these types of investments, you really should be thinking more in a 7 to 10 year timeline. And that doesn't mean that we hold the properties for 7 to 10 years. What that means is that you should plan on recycling your capital and putting your dividends and putting your equity that you get on the sale back into another investment. That's how you create that flywheel effect, right? Where you can really start to build a substantial amount of wealth. But it's a big lie and a big myth and misconception that passive income is going to get you rich overnight. If you have that expectation, you're in the wrong place. Let's move on to number 3 here. There is little risk when it comes to passive investing, or there is too much risk. On number 3, here's the reality about risk. Neither one of these are right or wrong. There are risks associated with passive investing, just like there's risks associated with investing in the stock market, right? Nothing is 100% risk free. What's important to understand is that there's different risks associated with different investments. So, for example, if you're investing in an A class property, the risks associated with that investment are very different than, or somewhat different, I should say, different than the risks associated investing in a C class property, right? Those are two different asset classes. There are risks associated with investing in different markets, right? Certain markets have less risk because they're growing fast, rapidly growing markets, right? And then certain markets are maybe tertiary or smaller markets, and there's risks associated with those because they're small, right? So there's different types of risks you have to understand, and different asset classes have different risks as well. So it's not too much or too little. Both of these are myths. There's definitely risks associated with it, but you just have to understand the risks before you make an investment. Misconception number 4, right? All passive investments are the same. That definitely is not true, right? So there's huge differences between different types of passive investments, whether you're looking at different asset classes, such as multifamily, car washes, self storage, mobile home parks, industrial, triple net retail, land. I mean, the list of real estate investments is huge. There's also there's differences also between different operators, right? So different operators are going to do things differently. So they're definitely not all the same. Some communicate more than others. Some are more hands-on more than others. So that's important for you to know that before you evaluate an investment, what type of operator you're working with, right? And there's also difference between the asset classes within the asset. So, for example, we just talked about that, right? So, if you buy a multifamily, there's an A class, a B class, and a C class that we typically invest in. There's also a D class, but we typically don't invest in those, right? There's different things that are associated with those that you need to know about. So, these are definitely not all the same. Just don't get, I always like to say, don't get fixated on just the numbers. Don't get fixated on just the returns, because if you're only fixated on the returns and you assume all passive investing is the same and this one just has better returns, you're going to find yourself in trouble and you're going to end up investing in a bad deal, right? So this is really, really important that you understand that they're not all sliced the same. And let's move on. And now that we've talked about some of these misconceptions, so how passive is passive investing, right? So I want to talk about a little bit more, peeling back the onion, peeling back the curtain a little bit, and talking about how these deals work. How passive or how active are you when you're actually a passive investor? So when you get started, right, it's your first time investing into a new project, whether you're an experienced passive investor or a new passive investor, there's always a little bit of initial effort up front, right? There's time invested in the education to understand that asset class, because you never want to invest in something you don't understand. And I can't emphasize this enough. Do not invest in something you do not understand. That's extremely risky. You don't want to get FOMO, fear of missing out, just because your friends, your family, your neighbors, maybe some other people you know are having a lot of success passively investing in a particular asset class. It doesn't mean you're going to have the same luck, right? So you really got to do your due diligence on what you're investing into first. That's really important. Then you have to do due diligence on the actual operator. Here at Headway Capital, we are operators, right? We're multifamily operators. We actually are hands-on operators. We actually manage the investment for you. And by managing the investment, we're going to manage the property, right? So that's the difference between an asset manager and a property manager. We both manage the asset and the property because we are vertically integrated. We have our own property management team, right? So you need to learn how to vet the operator and how to review somebody's track record, right? So this is something that's really important that you're going to do up front when you're first getting started in passive investing, or if it's your first time doing a deal with a particular operator. You have to look at their track record. That takes time, right? It's going to take a little bit of time for you to review what's going on there. It's not going to take a whole bunch of time, but it's going to take a little bit of time and effort, having a conversation, talking through somebody's track record, and then eventually reviewing their track record. And they should have something to present to you. So here at Headway, for example, we have a track record book that we send to all of our prospective investors after we have a phone call with them, showing them who we are, what we've done, where we've been, and where we plan on going, and how they can participate with us, right? So if you schedule a call with me or somebody on our team, you're always going to get that afterwards, right? So that's really important that somebody that you're looking to work with has that to share. Second thing is you actually have to spend time uh, doing due diligence on the investment offering, right? So when you actually have an investment, there's going to be a variety of documents that you have to invest time in reviewing. One is going to be the offering memorandum. This is a very detailed packet, typically 30 to 40 pages, sometimes a little bit more, that breaks down the entire investment. Why are we investing in this deal? What's the business plan? Why are we qualified to be your partner in this investment? What are the return metrics that you can predict? And how much money are you going to make at the end of the day? And how are we going to protect your capital? That's what the offering memorandum is all about. You have to learn how to read these. And I will tell you, the more and more of these that you read, whether they're from Headway or you're working with another partner, you have other relationships in the space, you want to read as many of these as you can. When I was first getting started, I can't even count how many hours I spent reading these, watching webinars for investments I wasn't necessarily planning on investing in because I wanted to get educated and I wanted to have that in my tool bag so that when I saw somebody's webinar, I had seen so many of them, I could tell who was good, who was bad, who had a lot of fluff, and who didn't, right? So reviewing these offering memorandums, reviewing these webinars, there's a time investment involved in that, and that's really important. The other thing that you have to review and spend time reviewing before you get into an investment is reviewing the PPM, which is an acronym for Private Placement Memorandum. This is the legal document that gets you into the deal. And it's very long, it's hundreds of pages, but you have to read this document thoroughly because if you don't read this document thoroughly, you don't understand the risks associated with the investment. You don't understand the returns associated with the investment. And at the end of the day, you could be signing something that you just don't understand, which is not a good investment strategy. So you have to spend time, a few minutes of your, if not minutes, if a few hours, investing time into the offering memorandum, investing time into the PPM, and ultimately investing time into the business plan. What is the business plan here? Does this make sense? Does the value add strategy make sense? And I will tell you, again, the more deals you look at, the more webinars you watch, the more offering memorandums you look at, the more PPMs you review, you'll start to learn what a good sound strategy is when it comes to a business plan for a value add multifamily project. So again, there's some time and effort involved in doing all this. And this is something you have to invest into because you don't just want to invest into multifamily real estate due to FOMO. Somebody else told you it was great. They made a bunch of money. Boom, I'm in. That's super risky. You want to make sure you're doing your due diligence thoroughly. And there's a time investment involved with that. So this is something that passive investors often forget about. They forget that they have to invest into their education, into doing due diligence. The other thing that we want to talk about today is ongoing responsibilities. There are ongoing responsibilities when it comes to passive investing. You might be thinking, whoa, this is passive. Why are there ongoing responsibilities? Well, settle down. Don't get excited. There's not a ton of responsibilities when it comes to passive investing, but there are some things that you have to be aware of before you invest. So let's dive into these. First, you have to monitor the performance of the asset. Me, when I passively invest in real estate, I read all the emails, which is really, really important. I've spoken to many investors who call me and they have question and they're not reading any of our emails. And if they would read their emails, it would save them a bunch of time and they would be really up to date on what's going on. Two, we put out monthly updates and quarterly updates as well on all of our deals, right? We're going to let you know what's going on at the property, how the operations are going, how the occupancy is, how the collections are, all the things that you really need to know as an investor. Well, we're going to put that in an email once a month and we're going to send it to you. You got to read it, right? That's really, really important. And that takes time, not a lot of time, 15, 20 minutes of your time, but that's really important. And last but not least, is you have to attend the update webinar. So we do webinar updates here semi-annually for all of our investments. You want to make sure you attend those webinars. They're a great opportunity to hear from us, to hear from the sponsor, and to ask questions over the Zoom meeting on what's going on, whether it's good, bad, or ugly. You now have a platform to ask those questions, right? So really important that you invest time in those ongoing responsibilities and don't just send somebody $100,000 and ignore all the stuff that they're putting out for 3 to 5 years and cross your fingers it's going well. That's a recipe for disaster. Communicating with the operator. So this is something that I would call is a little bit more optional depending on how the investment's going or your particular investment strategy. But communicating with the operator is something that you should definitely look to do if you have questions, right? That's something that we are very open about. And we love answering questions to all of our investors about the property, about the area, anything that you see that you have questions about. Reach out to us, schedule a call with me, schedule a call with Sid, schedule a call with Umar, schedule a call with somebody on our team to answer any questions you have about operations or financials or just investing in general. Don't be afraid to schedule a call. Ask questions. It's really important. It's something you should definitely invest time into at least once a year. These are 3 to 5 year holds. It makes a lot of sense to have a phone call with the person that you gave your money at least once a year, right? To just get an update on what's going on. And while we will always offer you, all of our emails have links to schedule a call. Our text messages have links to schedule a call when we push out updates. Make sure you take advantage of that. Click on that link, book a call at your convenience, and get on the phone just to see how things are going and to catch up. That provides you a lot of confidence in your investment, and it gives you a lot of clarity on what's going on the back end too. That may not be in an email. Sometimes a conversation make things so much better. Whether even if things are going great, just hearing about other future projects can get you really excited and let you know you have a lot of trust in the sponsor you're working with. Right. But here's the reality check. And I like to use this word reality check um, because it's true. Reality check is passive investing doesn't mean there's no work involved, right? There is some involved with your passive investing because you have to keep an eye on your investment. You can't just give somebody $100,000, cross your fingers it goes well, and hopefully they wire you back a bunch of money with a bunch of profit in 3 to 5 years. That's not a good strategy for passive investing. So there's some involvement on your end, and this is something you need to be committed to. You need to be committed to investing the time to go out, have phone calls, listen to the webinars, read the emails, do all the little things you need to do to manage your investment wisely, right? And it's really, really important that I also highlight the most amount of time you probably want to spend if you're new here and you've never passively invested before. First of all, welcome. But if you're new here and you've never passively invested before, there are two things I would advise you to spend the most time on. One is your education. Education is so crucial, and it's going to make or break your success as a passive investor. The second thing that's most important is vetting operating partners. Spend time getting to know your operators. Schedule that introductory phone call so you can speak to somebody on the team and make sure you have confidence in their ability to execute the business plan. And the fact that you just vibe with them, people forget to talk about how important it is that you vibe with somebody. There are going to be sponsors out there that you feel more confident in due to their demeanor, the way they speak. It could be all kinds of things. You want to work with somebody you have confidence in and somebody you're comfortable with. So getting on that phone call is really important. Look for opportunities as well to meet them in person. Here at Headway, we do monthly events to offer our investors the opportunity to come meet us in person. Meeting in person and shaking hands beats anything else, right? So come to our investor property tours that we do once a month. Once a month, we hold events where we invite all investors to come out, say hi to us, shake hands, meet our property management team, and see how an existing investment is going. That can give you a lot of confidence in your future financial decisions to invest with a firm like Headway, right? Go out to different events. If we're hosting an event, whether it be a bus tour or we're having a happy hour or we're doing some sort of educational session like this, come continue to attend these things because it's going to give you education, first of all. And that's probably the most important thing. But second thing is it's going to help you build a relationship. And that's what we really want. Not every firm is relationship driven, but we are relationship driven. Our slogan is it's all about the people. And that's because we understand that relationships are everything when it comes to investing, and relationships are everything when it comes to real estate. We want you to be a repeat investor. We don't want you to invest one time, and even if you made a bunch of money and you're happy, never invest again, right? So that relationship is so important to us. So spend time doing your due diligence on the operator, spend time doing due diligence on phone calls, emails, text messages, in-person events, do whatever you can to get to know your operator. That's going to help build trust so that when you make your investment, you sleep soundly at night. And I think that's worth the price. So let's talk about some tips for managing passive investments. Let's assume you've done everything we talked about, right? You did your education, you're watching webinars, you're attending different in-person events, you're getting educated on multifamily real estate, and you've made that first passive investment, or you're just an experienced passive investor. What are some tips for managing your passive investment once you've made that investment? First, can't speak enough about how important it is to stay informed. Staying informed on what's going on in the market is what I believe the most important thing when it comes to staying update on your passive investment. And I don't just mean the numbers, the financials, the P&L statements. I'm talking about what's going on in the economy, what's going on in the news, because there are things that are going on in the economy and in the media that could have an impact on your investment that aren't necessarily in the hands of the operator. For example, when COVID hit the industry, the multifamily industry, who saw that coming? Nobody saw that coming, right? Nobody saw that a virus was going to come to the US and really shut down the economy for many, many, many months. And we all thought there were going to be massive issues with collections and everybody would lose their property. Well, that didn't happen. Well, that's because we had a plan. We had a plan of attack to help residents who were in need, who needed government assistance to pay their rent. We were knocking on doors. We were going to doors with paper and iPads to make sure we were getting people signed up for programs that were available to help pay rent at some of our workforce housing assets. And we maintained all of our properties and maintained occupancy and maintained collections. Well, how does that happen? It requires hard effort and it requires a good operator. But staying in tune with what's going on with the treasuries, right? 10-year and 2-year, what's going on with inflation, what's going on with interest rates in particular are very, very, very important for the multifamily industry. So we put out something once a week called the Headway Report. If you're not signed up for it, I would highly recommend you sign up for it. If you are getting that weekly report and you're not reading it, I highly recommend you read it. We spend a lot of time building that, and it's basically economic multifamily data that will help give you insights into what's going on in the economy so you make smarter investing decisions. That's always our goals. We want to help you make smarter investing decisions. The Headway Report will do that. It's links and articles from all over the internet from different various sources that will make you a smarter investor. These things are so important, and I can't speak of them highly enough. Second, choosing the right operator. This is really, really, really important. So work with experienced operators. So as you're managing your investment, you're going to start learning about these operators. How do they communicate? How do they perform? Are they transparent? You have to keep notes on these things so you can make a decision if you want to invest with them again, right? So continuing to work with experienced operators is really, really important, and continuing to vet those partners that you work with. Again, I can't speak highly enough of this, and this is going to help you manage your investment. Keep talking to the operator you invested with, and then keep always looking for different types of opportunities from potentially different operators, right? Because different operators do things differently. We don't do industrial, for example. If you wanted to be an industrial investor, well, you need to start the relationship building process all over again. If you're looking to diversify your real estate, right, you would need to go form a relationship with an industrial operator. So always be looking to vet experienced operators. Third, diversifying your portfolio is one of the smartest things you can do as a passive investor. What do I mean by diversifying your portfolio? So you want to spread your investments across different asset classes and potentially different asset types. What does that mean? Different asset types would mean multifamily real estate, industrial real estate, self-storage, mobile home parks, hard money lending. There's so many different asset classes where you can make money in real estate. Spreading your investments across them makes sense. So you're not all in on one potential asset class, right? We love multifamily over here at Headway. I love multifamily. A large part of my portfolio is in multifamily, but I also love other asset classes. And I'm always looking at opportunities to invest with experts that are experts in their field in that particular asset class. And I always recommend people do the same. The second thing is look for opportunities to invest in different asset classes within that asset type. For example, we put out A-class deals here at Headway. We put out B-class deals here at Headway, and we put out C-class deals here at Headway. Those are different asset classes, all within the same multifamily sector. An A-class is going to be a newer product call it 2000s and up, 2010s and up, more likely. It's going to have more amenities, more luxuries, and be a higher quality, a newer build, and therefore charge higher rents. Then there's B class assets, which is not call it 1980s to early 2000s product, still in a really solid neighborhood, but just a little bit older and still workforce housing, still affordable. Then there's your C class properties. Those are going to be your 1960s to late 1970s product, boiler chiller system, older property, and very likely a workforce demographic. So looking to cater to people that work at blue collar jobs, constructions, restaurants, different things of that nature, right? Those are all great asset classes. So if you're looking to invest, try to diversify, because if the market, for example, turns and the economy is drastically impacted and we go into recession, those asset classes, they respond differently in recessions, right? The B class asset, I would argue, is the most resilient, because whether times are good or times are bad, people are always looking to move into the B class space. It's just nice, safe, stable, good neighborhoods, affordable living. If you're living in an A class property and you lose your job, where do you go? You downgrade to a B class property, right? So a lot of people that are in that A minus space might move into a B class property. If you're in the C class space, you're always looking to stay in that space more likely until you get a raise. Maybe you're moving into that B class space. So the C class space is great for people as well, but there are risks associated with it. Of course, it's older property. There's execution risk. The tenants are typically lower income, which means they could have trouble paying rent during a recession, right? So there's different sort of risks, and spreading your risks across those asset class will help you maintain a more stable portfolio in the long run in case of a recession, right? So reduce those risks by spreading your investments out and by just looking for different opportunities, right? And last but not least, the last tip I want to give all of our passive investors about maintaining their investments is to make sure you set realistic expectations, right? Understand the timeline for your investments. These are long-term investments, 3 to 5 years. Typically, you're going to want to also recognize the potential for fluctuations in income, right? It's really important that all investors understand that these deals are not perfect. They don't always go accordingly to plan. Sometimes distributions could start early. Sometimes distributions might start late. Sometimes distributions might get paused if the property is going through a challenging situation. Income goes up, income goes down. This is a business, right? When you're buying a multifamily asset, you're buying a business. It has employees and it has customers. It just so happens to be that we consider real estate. Remember that businesses have fluctuations in income based on seasonality, based on the leasing seasons, based on expenses, based on what's going on with the market rents. There's going to be fluctuations in income. So the returns could also have some fluctuations as well. Of course, if you're working with an experienced operator, they're going to do a much better job forecasting expectations and forecasting those returns. So you don't have to worry as much about volatility, but it still can happen because there are things, of course, that are sometimes out of everyone's control. So, but you have to recognize that going into the deal, and it's going to help you maintain a sound investing strategy and a sound mind as well while you're investing. All right. So let's talk about common challenges that are experienced when it comes to passive real estate investing. So again, I've talked about this a little bit, but I want to make sure I highlight these challenges before we wrap up here at the end of the presentation. So we've talked a lot about is passive income really passive, right? What you have to do to stay active. I like to call it being an active passive investor. We've talked a lot about the different types of asset types and what you can do to sort of mitigate risk. But let's talk about these challenges and what some mitigation strategies are for them, specifically when it comes to multifamily real estate, which is our bread and butter. The first challenge that you could experience as a passive investor in multifamily real estate is market volatility. So, market volatility occurs when there are economic downturns that can affect the property and the overall cash flow, right? So, how can you mitigate that? How can you mitigate market volatility when it's out of your control? Well, first of all, diversification in different asset classes, as we've previously discussed, is really important and will help mitigate some market volatility. Secondly, assessing risk is really important as well, based on the underwriting and how conservative or how aggressive it is. Here's the reality: different operators underwrite using different strategies. Some people might say their underwriting is conservative. I would actually argue that most people will say their underwriting is conservative. I have never personally met another operator who says, "Yep, my underwriting is aggressive, and that's how we do business. We get aggressive over here." Nobody says that. Everybody says their underwriting is conservative, but here's the problem. The term underwriting is conservative, or the phrase, I should say, the phrase underwriting is conservative is a subjective term. That's the truth of the matter, right? What's conservative to me may not be conservative to somebody else. What's aggressive to me might not be aggressive to somebody else. And that's really important to know that. And this goes back to my other point. This is why it's important to get to know the operator. Getting to know the operator, you will get to know their underwriting strategy and what they're focused on. For example, here at Headway, we're really cash flow driven, cash flow and equity multiple. That means we're trying to make sure the property cash flows throughout the life cycle of the deal because we want our investors to get distributions along the way. And we're really concerned on the exit valuation. We want to make sure the property sells for a good value so we can get that big pop at the end and you can get a big check, a big equity check on the profit split when the property sells. Those are our two most important focus when it comes to the returns. Some people are more IRR driven. And if you don't know what that means, that's okay. IRR is an internal rate of return. And that is basically valuing your investment over the time value of the deal, right? So some people are very IRR driven. If you're working with an operator that's IRR driven, they might not be cash flow driven. They might not be looking to maximize cash flow throughout the life cycle of the deal. Is that bad or is that good? It depends. Depends on your investing strategy. It's not bad or good. Some people are very IRR driven because they don't need the cash flow. If you're a doctor, if you're an attorney, you make three, four, $500,000 a year or more. You probably don't think a lot about generating cash flow when it comes to your investments. You're more than likely looking for wealth protection, equity growth. You want your money to grow, and you're looking for a place to park your money where you don't have to think about it and work very hard. That's a great strategy, looking for IRR type investments. But if you're looking for cash flow along the way, then you have to look for a different operator that's more cash flow driven, right? So understanding how operators underwrite and what they're really focused on is really, really, really important. Second thing, management issues, right? These are some common challenges in multifamily investment. And a big challenge that you could experience as a passive investor in multifamily investment are property management issues. So, how do we mitigate those? So, first of all, a property management issue is when a poor property manager is not doing a good job executing the business plan and it's leading to poor performance in the property. Maybe you're not getting your distributions, or maybe you are getting your distributions, but you're not getting as much as you thought you were going to get because the property is having higher expenses or the property is not generating enough income. Well, that could be due to poor property management, right? So, how do we mitigate that? The best way to mitigate poor property management is to work with an experienced operator that's vertically integrated. So, over here at Headway, for example, we're vertical. That means we have experience self managing all of our assets. That is really important because we know how to get our hands dirty. We know how to squeeze juice out of the lemon. We know how to turn around a property that's struggling. We have the resources and the experience to do it. We've been doing it for 7 years, right? So you can mitigate some of that risk by just partnering with someone experienced. And I will tell you, having invested in projects with newer operators before, just because somebody's new doesn't mean that they won't be successful, but it definitely increases the chances because you can't just walk off the street and assume you know how to manage a multi-million dollar investment property. These are 10, 20, $30 million businesses. That's what we're paying for them. They generate millions of dollars a year in income. You can't just walk off the street from your W 2 and assume you know how to manage the asset, even though you have a property manager there that's being paid 2%, 3%, 4% to manage the asset. Well, guess what? You have to manage the asset manager. You have to manage that manager that's on site, the property manager, right? So you can't assume that somebody knows how to do that. So working with somebody experienced is a great way to mitigate this risk. Last but not least, unexpected expenses, right? This is a common challenge that we see in multifamily real estate that you'll see with any business, right? There's going to be unexpected expenses that pop up along the way. Repairs, increased vacancies, emergency situation, these types of things can impact your overall returns. And the best way to make sure that unexpected expenses don't mitigate or damage your returns along the way is to make sure you're working with an operator who maintains extra cash in the bank. We should always have reserves for a rainy day. And that's something that's really important to us here at Headway. We keep anywhere from 4 to 6 months of operating expenses in an account separate, sitting there waiting for an emergency, right? So if we were to go to a situation like COVID again, if we were to have a property that had a fire and one of the buildings was unavailable to lease and our income dropped, we have insurance and we have extra reserves for those types of situations so that we don't get caught in a situation where we have to hand the keys back to the lender, right? So maintaining a really strong cash reserve position is crucial for avoiding challenges in your multifamily real estate investment. So really important here. Last but not least, let's talk about long-term success in passive investing. And I think we've kind of highlighted these things quite a bit over the last few minutes, but let's talk about them anyway. Patience and discipline is really, really important when it comes to investing. Again, if you're investing as a passive investor in multifamily real estate and you don't have patience and discipline, you're not going to make it, period. It's a long-term strategy for long-term people. We have a kind of cheesy saying in our industry: passive investing in multifamily real estate is a business where you want to build long-term relationships with long-term people or play long-term games with long-term people, right? So however you want to say it, it's important that you understand that this is, you have to have discipline, you have to have patience along the way. And success, again, success requires consistent monitoring and adjustments, right? So the multifamily industry is constantly changing. The commercial real estate industry is constantly changing. You may have to tweak your investment strategy as the market is changing, or you may have to tweak your investment strategy as your goals change, as your life changes, as you're approaching retirement. You might begin investing more for cash flow than you will for equity upside. If you're younger and you have a longer runway for retirement, you should be more equity upside driven because you may not need the cash flow as much because you have a good, solid, steady job, right? So success long term, if you're planning on being a passive investor for 10, 20, 30 years, you need to understand what your current situation is, evaluate your goals, set a strategy, and be ready to tweak that strategy throughout your investment horizon, right? I always like to say, plan in pencil, not in Sharpie, because things change. The second thing that is required for long-term success in passive investing is continuous learning. You will not be a successful passive investor if you're not constantly educating yourself on what's going on in the market. Real estate is constantly changing, right? We talked about that, and you have to stay up to date on what's going on. So engage in educational events where you can, attend these webinars, read news articles. If you're looking for resources to learn about what's going on in the multifamily market, shoot me an email, shoot me a text. I am always happy to share some of the best resources that I have found along my journey to help give me insights on what's going on in the market, objective insights, right? Not subjective, opinionated pieces. We can find that stuff all over. You'll see headlines about, real estate's falling apart and this is happening over here, or the economy's going under, or the stock market's about to crash. And guess what? Nothing ever happens, right? So we're looking for objective pieces that just give you factual data and information so you can draw your own conclusions. Reach out to me. I'm happy to share those types of resources, right? Third is learning to understand if you're going to be a long-term successful passive investor, you have to reinvest your earnings. A lot of people forget that that's a big crucial part of the strategy because we're looking to build long-term wealth here. We're not looking to be a one-hit wonder and invest one time, put $100,000 in, get $200,000 out when it's all said and done, and ride off into the sunset. Nobody's ever done that and been super happy and retired with $200,000. We have to continue to reinvest in order to see long-term wealth. For example, you invest $100,000. Let's assume that it's a deal that's providing a 2x multiple, meaning it's going to double your money in 3 to 5 years. Let's say in 5 years, that 100,000 becomes 200,000. We'll reinvest it, right? Reinvest that 200,000. Maybe you keep a little, but reinvest that 200,000. And guess what? When you reinvest that 200,000 in 3 to 5 years, it's going to, ideally, if the deal goes well, you're working with good operators, you get 400,000. Right now, your 100K in 10 years turned to 400,000. It took 10 years, so a lot of patience, right? Here we go. Let's do it again. Let's take the 400K. Let's reinvest it and double that. Now you got 800K. Well, imagine if you were to do that and you invested multiple times a year. What if you had a plan where your goal was to invest 200,000 every year, or 250,000, or however much cash you feel comfortable with moving from your portfolio? Maybe you have some IRA funds you want to allocate toward this, and your plan is to invest 250K a year. Well, again, we're speaking hypothetically here. But if your first investment's 250K and you spread that across 2 deals, 3 deals, however many you want to spread it across, let's assume baseline here that they're all doubling their returns in 5 years. Well, in 5 years, let's assume all those deals sell. Your 250K is now 500K. Well, what if you do that again? What if you put 100K in 5 deals and in 5 more years, that doubles, right? So your 500K in 10 years turned into $1 million. And you just continue to recycle that capital if you've got a 20 or 30-year timeline. And even if you don't, again, just using this strategy as part of your overall retirement planning can be really crucial and can really help amplify your quality of living as you approach retirement. But again, the key is reinvesting and not assuming you're going to get rich over 1 or 2 deals. This is how you build wealth over a long period of time. Last but not least, building a diverse portfolio, right? So we've talked about this, we've exhausted this topic. And again, I want to highlight how important it is to spread your investments out. This is going to help mitigate risk while maximizing your performance long term. So as we kind of wrap up here today, here's the final statement I want to leave you with. We talked a lot about, is passive investing really passive? The answer is no. Passive investing is not really passive. There's some work involved. There's work involved in educating yourself. There's work involved in vetting the operator. There's work involved in vetting the deal. There's work involved in vetting the legal documents. And then there's work involved after you decide to invest with checking emails, reading the investor updates, attending the webinars, looking at the financials, scheduling phone calls with the operator. These are all things that require a little bit of time and effort. But if you're looking to build wealth through commercial real estate and multifamily real estate in particular, this ROI on your time is substantial because you're not having to deal with tenants. You're not having to deal with toilets. You're not having to go out and find properties and talk to realtors and talk to lenders and find investing partners. We do all that work for you here at Headway Capital. So passive investing, although there is still a little bit of a time investment when it comes to all the things that I just mentioned, is still an extremely powerful strategy and has a huge ROI on your time. The amount of wealth that you can build compared to the amount of time you've invested into these types of projects is substantial. So I would encourage everyone to, again, continue to invest in your education, continue to build relationships with great sponsors so that when you finally decide to invest, you have more confidence, right? You have more education and you feel better when you put your head on your pillow at night, knowing that you've at least done your due diligence. Whether that deal goes great or the deal doesn't go so great, at least you can feel good knowing you did your homework. Nothing feels worse than when you put your money in something and you're constantly worrying. Even if it's going well, you're worrying because it's something you didn't do your homework on, right? So that's my final statement. That's the message I want to leave with you tonight as we wrap up this webinar. Let's talk a little bit about our private investor club. I want to make sure I highlight this before we hop off. If you are not a part of our private investor club, please reach out and sign up to me. If you're interested in gaining access to our private investments and seeing some of our in-person events, coming to our property tours, online real estate educational webinars, and seeing some of our investment opportunities, please sign up. We have to fill out an application and you have to schedule a call with somebody on our team. And we work with both sophisticated and accredited investors. You can sign up by reaching out to us or, of course, scanning the QR code on your screen here. If you're in a safe space and you're not driving, you're on your tablet or you're on your computer, scan this QR code to apply for our private investor club. And I also want to talk about, for those who are interested in generating passive income and monthly dividends, they love cash flow. This is one of our open investment opportunities. It's called the Headway Capital Income Fund. We've partnered with a hard money lending company to provide you the opportunity to invest into a hard money fund that has funded over $277 million worth of transactions. It has been around for 5 years, and borrower demand continues to be absolutely strong in this category. So if you're an accredited investor, which means you meet the net worth or income requirements, and you're looking to get monthly distributions, this is a great investment for you, particularly because it actually provides an element of liquidity. This one has a 90-day liquidity option, meaning if you invest in this in this project, into this fund, I should say, it's not a project, you can pull your money out in 90 days or less, right? So that's a really different strategy compared to investing in multifamily. So it's a great option, great alternative, I should say. And here are the returns you can expect to get depending on your investment. If you invest anything less than 100K, 6% month annual dividends. 100K to 500K pays 8%. Anything under a million pays 9. And then anything over a million earns 10%. And we always pay our investors first. So if you want to learn more about this, scan this QR code or reach out to me. I'm happy to share more info on this. This is also on our website, headwayinvestment.com. You can learn more about the income fund. And if you like receiving mailbox money and monthly dividends, or if you want to let your money compound, we do have that as an option. This is a great investment strategy. So let's move on to Q&A. I do see a few questions here. First one here is there a link to sign up for the newsletter? I just made note of that for you, Mr. Carl. I will go ahead and get you signed up for that, but I will also make sure I drop the link in the chat. So I will go ahead and do that now while we're answering some of these other questions. Here's a great question we have here. In your analysis, how do you plan for acts of God like floods, especially in the Houston area? This is a phenomenal question. So before I answer that question, I am going to put our website here in the chat and make sure that everybody can see it. If you go to our website and you scroll down just a hair, there's a section that says Get Started. If you subscribe, it'll ask you to enter your full name and your email. That's how you subscribe to our newsletter. So just go ahead and scroll down just a hair right under the hero banner where it says Get Started. It says subscribe to our email list to learn more about how you can passively invest. That'll get you on our newsletter list. So with that being said, how do we plan for acts of God like floods, especially in the Houston area? It's a great question. So first of all, we try to avoid buying properties that are in a flood zone. Now, that doesn't guarantee anything. Harvey was a great example back in 2017. That was a 500-year flood, meaning it only happens once every 5 years. Well, I guess we got caught on the wrong end of that, right? We didn't have any properties that flooded, thank goodness, but we know lots of people that did. But first step is to make sure we're buying deals that are not in flood zones, right? So we look at the flood map aggressively. We know before we even make an offer on a deal if it's in a flood zone. And we try to avoid those deals, right? To be quite frank. Second thing is we always carry insurance, right? So we have all the insurances you really need. For, the regular, if we're close to the coast, the lender is going to require us to have insurance for wind, for example. If we were to buy a property in Southeast Houston, for example, TWIA is a big deal there. The essentially wind insurance. So we will carry all the insurance we need to sort of mitigate any potential risk, including loss of income, right? So we have insurance for fires, for example, right? Which is not necessarily an act of God, more of an act of a person. But let's just say an accident happens and a building burns down. Well, we're going to have insurance for that to file a claim and get money back to rebuild. We're also going to get lost income insurance to make sure that if we lose tens of thousands of dollars from that building being down, if not more, we can pay our bills, right? We can pay the lender. We're not going to fall short on our mortgage. So that's the best way I can answer that question is how do we plan for those acts of God? And we just try to plan accordingly and buy in good areas because that's a question we get a lot being here in Houston. We can't avoid everything, but we can do our best to buy properties in great areas that aren't at higher of a risk compared to some things closer to the coast. Let's see what else we got here. What is your favorite way to mitigate risks when investing in multifamily? That's kind of a trick question. I did talk about some risk mitigation strategies here when it came to these three things here. And I will say if I had to pick one, my favorite way to mitigate risk is to get really educated and look at a lot of deals. The more deals you look at, the more you're going to realize which ones are BS and which ones aren't, to be quite frank. There's a lot of deals that will come out every year, right? We try to do 3 to 4 deals a year here at Headway, so call it 1 per quarter. But there are other deals on the market, right? There are other investment groups out there. We're not the only one in the game. And the more deals you look at, not just from us, but from other operators, are going to give you confidence in your investment decision and help align with your strategy. Again, different deals are driven by different things. Some are driven by cash flow, some are driven by IRR. Those are things that are all really important. So you got to find an operator that works for you. So the best way to mitigate risk, in my opinion, is to look at a lot of deals. And eventually, you got to take a leap of faith, right? If you look at 100 deals and you haven't invested in one yet, let's be realistic, you're a tire kicker. Right. If there's plenty out of 100 deals, it's impossible that all 100 of those, went in the toilet and they were all bad deals. right? Really, what happens is if you look at that many deals and you still haven't invested, is you don't have enough confidence yet because you haven't invested enough in your education, or your risk appetite just doesn't align with the strategy, and that's okay, right? If you don't think you should be an investor after looking at 100 deals, move on to something you have more confidence in, whether that's stocks or flipping houses or whatever it is, right? Being a passive investor is definitely not for everyone. How many interest rate reductions does the Fed need to make it worth refinancing any passive investment opportunity? That is based on the property. That's a good question. It really depends. It actually has nothing to do with the interest rates deductions per se, Ron. I would say it has more to do with where the property is currently at. So, for example, if you invested in a property back in 2021 that had a 3% interest rate on fixed rate long term, well, dropping the interest rate's irrelevant because that property is probably doing just fine. And if you were to refinance, even after a rate cut, you'd still be refinancing into a higher loan. Now, that doesn't mean that it's a bad strategy because you could be doing a cash out refinancing and pulling some cash out, returning it to your investors and keeping the deal, right? But you will be paying a higher mortgage going forward on that investment. So it's really important to understand that it is deal by deal, and there isn't a specific number of rate cuts, but I will tell you that the more the merrier, right? The first rate cut is projected to come in September of this year. We don't know if it's going to be 25 basis points or 50 basis points. Most people think 25, but could be 50. And we'll see what happens. But the more the merrier, right? So the bigger the rate cuts and the more rate cuts they have, that's welcome news to all passive and active investors. Where would you say there are better performing assets in the Houston market? Is it Houston proper, or the outlying suburbs of Woodlands, Katy, Clear Lake? That is a good question. I would say that it is deal by deal. Personally, we like to invest based on basis and location. So basis just means price, and location means the submarket. Houston's huge, right? You guys know that how big Houston is, and there are some areas that I personally would not invest into. And they're not necessarily areas like southeast, northwest. It's more of like communities, right? Pockets. So Houston is a very diverse city. And I think that your better performing assets are going to perform in better school districts, right? So if you're in Cy-Fair, if you're in Fort Bend, if you're in certain parts of Houston that are known for having better schools, you're going to have a better clientele. So that's going to be in your suburbs, for sure. But it doesn't necessarily mean that it's not a city of Houston property. It just means that, maybe it's in Spring Branch. Maybe it's in West Chase. It really depends on what you're paying for the property, the interest rate, and the business plan overall. But I mean, we love areas like Katy. We love areas like Sugarland. We love areas like the Woodlands. We love areas like Bel Air, the Galleria. I mean, there's a lot of great areas in Houston, and those all can perform really well. But you know what? You can make money on any property in any area if you buy it at the right price. I'll just leave it at that. Right? Don't overpay for your properties is really important. Is this webinar recorded? Yes, it will. It is recorded. It will be available usually within 24 hours. So we'll make sure to get that recording out to you. You'll find it on our YouTube channel, and it will be available. It'll be on our weekly emails that come out on Mondays with our newsletter. It'll be at the bottom of there as well. I see great passive investment opportunities in Houston and the Dallas area, but not many in Austin. Any opinion why? Yes. So Austin is a very interesting market. As we've known, a lot of people have migrated to Austin over the last several years. It's a big joke here in Texas that if you go to Austin, it's like being in California. Whether you believe that or not, is irrelevant, but it's true. It is factual data that a lot of migrants have came there, which have caused a lot of rapid inflation in the market. So what we saw in 2020 and 2021 coming out of COVID is because people were moving a lot during COVID. A lot of people from the West Coast, particularly California, moved to Austin because it provides a similar lifestyle, a lot of similar political influences there, a lot of similar amenities there. It's one of the few places, major cities in Houston, that's major cities in Texas that's not flat. A lot of outdoor activities, a lot of tech companies are there, right? Tesla, lots of just big companies are there, right? So it brought a lot of Californians. That caused prices to rapidly increase. And what it did is it compressed cap rates. And I don't want to get too technical here, but cap rates are essentially the cash flow you would expect to generate on a property if you were to pay for it all cash, which we obviously don't do. We use debt. But if you were to pay all cash, that's essentially what a cap rate is. So the cap rates in Austin in 2021 got severely compressed because of the demand there. Everyone thought it was the hottest city in America. It was the best thing since sliced bread. Everyone's moving here. It's booming like crazy. The real estate market was going crazy and the cap rates got compressed. I mean, there are people that bought properties there, with a three handle on the cap. So 3.5, 3.75, 3.25, low fours during COVID. Well, when the market cooled down, when the Fed started raising interest rates in 2022, all those properties are essentially underwater because the owners overpaid. Now, it doesn't mean that they're all, getting foreclosed on and it's a bad place to invest at all. It's just a factor of timing. And some of those deals might still be doing okay if they bought them at the right price or they just have long-term fixed rate debt and they've been able to execute their business plan, right? There's probably plenty of deals cash flowing, but that's part of the reason why you don't see a lot of deals in Austin. The market is in the process of cooling down and resetting itself because it got too hot too fast and people were overpaying for things. So you'll see more opportunities in Houston because our cost basis makes more sense. There's more of an ability to generate cash flow here than there is in places like Austin. And you'll see the same with DFW. DFW has such strong fundamentals in growth that people are constantly building there because people are constantly moving there, that there's a lot of opportunity to make really good money. Not as much cash flow as Houston necessarily, but really strong equity upside. You're going to find great deals that are more IRR driven in DFW. So great question. Probably a little bit more than you were looking for, but hopefully that answers your question. Um, I see. It's true. I live in Austin, and I see the West Coast invasion daily. I love that. Thanks for sharing your opinion there. Houston seems to be the main market where this has been tax abatement deals. Reason. Good question. Houston has been very open to working with property owners to provide affordable housing. As of the last couple of years, we've seen a lot of deals involved in the multifamily space that qualify for a program that the city of Houston and surrounding suburbs came out with that essentially provide you the ability to get into a special program for a very long period. These are long-term commitments, 10 plus years, where you essentially, as the operator, the way you benefit from it is you don't pay any property taxes, which is substantially impactful in Houston because our property taxes are high because we don't have state income tax. So what the city of Houston is doing is they're providing deals where we call them like PFCs, where essentially you go into the city, you apply for a PFC or a housing credit, and you say, "Hey, city of Houston, I've got this property. It's a great property. These are not slum properties. I'm actually seeing them very often on newer products. I've seen a lot of 1980s to 2010 properties, B and A class properties. You go to the city of Houston, you say, "Hey, I want to apply for this." And if the city grants you permission, they will partner with you on that deal. And their way they partner with you is they waive your tax commitment. So you're saving hundreds and hundreds and hundreds of $1,000s a year in taxes. And in return, they are getting a slice of equity on the deal. So that it's not free. But that's essentially kind of long story short. I'm not an expert in this. But that's essentially what's going on. So the city is essentially accepting equity in return for tax abatements, right? So it's a phenomenal investment opportunity if you see it. It doesn't mean that it's risk free and it doesn't mean that it's going to be a slam dunk. There are strings attached. You now have the city of Houston as your partner, right? The pros and cons that come with that. They make money off of it, so they're gonna be incentivized as well. But there are substantial opportunities to make more cash flow in these types of deals because you're not paying property taxes. So again, hopefully that answers your questions. Let's see here. Do you have any leading funds that pay constant interest rates? I think what you might be talking about, Mike, is this is one of our funds that pays a consistent distribution. This one here, the income fund. If you can reach out to me specifically, I'll put my email here at the second, Mike. And if you have any questions about this in particular, reach out. But this one pays monthly distributions. If you invest $100,000, you would get 8% per year. So that would be $8,000 a year for your $100,000 investment. If you divide 8,000 divided by 12, that's your monthly distribution. So this pays monthly like clockwork. We've never missed a payment. It is substantially funded, meaning I'm not going to say it's risk-free, but we've given out over 1,400 loans in this program, and we've only ever had 3 defaulted, and we were able to sell those 3 notes to other investors for a profit. So we have had 0 properties in this fund that have lost any money over the last 4.5, 5 years. So again, not risk free. We can definitely answer any questions when it comes to the risk that comes with investing into the fund, but this plays like clockwork. Whether you're in the 6, 8, 9, or 10%, you'll get a monthly dividend from us for investing into this income fund. So I highly recommend it. If you're looking to invest in multifamily and you're not finding a deal that you like, I always recommend come take a look at this as an option. You can park your money here and be earning 8, 9, 10%, 6, 8, 9, 10%. And if you see something you like, with here at Headway, you can reach out to me and say, hey, Brian, I put 200K in your income fund. Can you move 50 of it over into your deal? Can you move 100 of it over into your deal? So it's just I like to kind of consider I have some money in this as like a high yield savings account, knowing that it's kind of like a 3-month CD. You can pull your money out and you send me an email, and my promise is I will get your money back in 90 days or less. And I will tell you, unless you're investing 7 figures, it doesn't usually take that long. It's more like 45 to 60 days, but just want to highlight that. So appreciate you asking. You can compound this as well. So for example, let's say you invest $100,000 and you're making $8,000 a year, but you don't want that $8,000. You can actually leave it in, and now your investment is compounding over time. So if you reach out to me, I can send you a chart. It'll show you what your money looks like over 1, 3, 5, 10 years if you were to let your money compound. So you can let your money compound if you don't want the monthly distribution. So if you're a high income earner and $8,000 a year doesn't get you excited, leave it in, let it compound over time, and eventually you can pull it out 1, 2, 3, 4, 5 years later, and you'll have substantial returns from that. So I'll definitely make sure you get that information over. So let's wrap up as we're getting right past the hour here. Here's our contact information. You can reach out to me directly. I am Brian at headwaycapital.us, or you can email investor@headwaycapital.us, and it will go to all of us on our team, and I'll make sure I'll reply to anybody who's reaching out due to the webinar here. So please reach out to us. First of all, I want to say thank you to everyone who attended tonight. Hopefully this was educational and gave you some insights onto, is passive investing truly passive? I look forward to hosting the next webinar. We do have another webinar next week where we're going to talk about cap rates and what is a cap rate. So if you're not familiar with what a cap rate is, please make sure you keep an eye out for an email that'll come out tomorrow to sign up for that webinar. And we look forward to seeing you there. Have a great day, and thanks for attending.